Florian Grummes from Midas Touch Consulting is back to talk about the precious metals shakes, shines, and sentiment. This and more on this week's episode of Metal Money. I'm your host, Patrick Vieira. Florian Grummes from Midas Touch Consulting, welcome back to Metal Money. How are you doing?
Hey, Patrick. Thanks for having me. I'm doing good. Looking forward to talking with you again. Thanks for having me.
Great. Glad to have you back, Florian. Appreciate it. Last time we spoke on the 8th of February back in 2022, this year, you mentioned how we have not seen perhaps the one last time where weak gold hands throw in the towel. And you mentioned how there has been positive sentiment for gold for the past couple of years. Are we starting to see this sort of a tree shaking, removing some of these weak hands with gold continuing on a downward trend extending from last week?
Well, I mean, we first of all had this nice and strong rally into early March. Gold nearly managed to make a new all-time high. It failed $5 below the top from August 2020. And I've been writing about it the last 2 months that I expected a failure above $2,000, and that actually has happened. So far, Monday, today, a week ago, we've seen gold trying to recover back to $2,000, but it failed and has been selling off rather sharply. And now we're trading back below 1920. So it seems that this very bullish setup from last December has played out. We've seen a nice, strong rally out of this low at, I think it was 1750. Gold rallied $330 within less than 3 months. It became very overbought. Yes, obviously it was mainly fear-driven by the war in the Ukraine, I assume. But we also had clear technical signals that gold was due to break out. We had this nice rally, and then, of course, it went up too fast, too high, and it came all the way back down to, I think the low was 1890 so far in this correction. It took a few weeks of sideways consolidation, tricky moves like always, and now it has failed at the $2,000 level, which is the 61.8% retracement of this first leg down since March. So it looks more and more corrective what gold is doing here. And I think this also now has to do with like the bigger picture in all the markets, because wherever you look these days, you see actually red, a sea of red. And it's not only the stock market, the cryptos are under pressure. And yeah, basically everything is getting sold off. The only thing that is strong is the dollar. And it's actually not a risk-on environment anymore. And I mean, we know that in the stock market, this is going on already since November. We had a nice bounce out of this fear low driven by the war in Ukraine. But now last week, I think it became more obvious again that the stock market is still massively under pressure, and it might be in a bear market. And that actually would probably continue to mean risk off in all assets.
This does seem to be a time of inflation for sure. We're all seeing it. But yet gold seems to have some very, very hard resistance at 1980 and 2000, as you mentioned. Why are we seeing this extremely hard resistance at those price points?
Well, maybe let's go to a chart about gold then. I have, first of all, this long-term chart of gold, where I also try to show the cup and handle, the potential cup and handle in the gold market. And you can see if you connect the all-time high from 2011 and then the new all-time high from August 2020, and you get this massive resistance zone currently around $2,000 to $2,100. And it's a psychological number, first of all. So, of course, you have a lot of people that at some point bought gold over the last 2, 3, 4 years and had a rather hard time and are happy to sell at those price levels. But you also have the bullion banks that don't want to see gold breaking out above these levels. And then you generally have this pressure now in the whole financial markets. And yeah, 2000 is a round psychological number. It's been the 61.8% retracement. And I don't think that gold will have the power to break out anytime soon above this resistance zone, actually. And if you look at this monthly chart here, going back to 2011, we have this cup and handle. Potentially, people expected this handle to be ending now. I've been saying since a few months, since I think last October or November, that this handle might need a bit more time. People need to be a little bit more patient. We have still a buy signal here on the monthly chart, but if we zoom in into a weekly and then daily chart, you will see that the picture is not that positive anymore. And I actually think that it's much more likely that gold will go back to its 200-day moving average, currently around 1820-ish, I think. So I continue to expect gold to correct into the summer. 1840, 1830 at least. This is actually what I expect. So this is the daily chart for gold, where you can see we had here this. This is the top in early March, and then gold quickly sold off and sold off again, and then we had this multi-week consolidation here. Two lows. First it was 1895, then 1890, and then gold managed to recover one more time, and just a week ago it failed here at the $2,000 level. And yes, the daily stochastic is nearing this oversold zone, so there is a good chance that we maybe get another bounce in the next few weeks. But I believe that this 1960, which we know from the last 2 years, where gold has failed, I think 3 times, is still a resistance in the market. And I think if gold manages to climb back to this number, which is already some work from where we are trading right now, so I think gold will fail there again. And seasonality is not supportive until midsummer. So typically you get another 2-3 months of weakness, and usually you see a low somewhere in June, July. So that's still what I expect. And so I'm rather risk off when it comes to gold right now, and I don't buy into these high inflation numbers anymore. I used to be a crack up boom bull, super inflationary a bull for the last 2 years, long before many people were able to see it. But I think things changing now, and the main reason is this chart here. This is like the US government bonds, the 10-year yields. And this red downtrend channel that you can see here is actually going back all the way to 1980. And since then, interest rates, the yields have been falling. And that has been very supportive for everything financial markets, right? It's been very supportive for the stock market, of course. It's been very supportive for the real estate market, and it has been also very supportive for crypto, for example, and most recently also for commodities. However, this has dramatically turned around here. So this is the Corona crash, where yields really crashed to a 50-year low. And you see that this is a inverse head and shoulder pattern. And just from a technical perspective, this points to maybe at some point in the future yields at 10%. And that would kill, I think, nearly everything in the financial markets. So because money conditions, liquidity conditions would be so tight at that point, and that will affect any market, any speculative market. And of course, right now we are testing this upper edge of the downtrend channel, so we might see a pullback and yields coming down again. It's fascinating how much the market has been pricing in rate hikes here, while the Fed has not done anything besides more and more aggressive talking, but in the end still cheap talking. So they haven't done anything. They only managed to talk the markets basically into that scenario. Let's see how this plays out. But at the same time, I think the stress in the system is really high already, and I'm not sure if they will be able to control it. So in the longer run, this is quite a risk-off environment, I would say. And at the same time, and this is another chart that I brought. This is not from me. It's by Michael Cantrell, the chart. It shows that right now the market is pricing in a record tightening like never before. So this chart also goes back to the 1980s. And sentiment is quite fearful already. So you could definitely also make the point that you get a bounce in the stock market at some point rather soon than later. But if the stock market goes up, I think gold will have a hard time. And so these are two diverging views, basically, that I just present. I think in the short term, it's maybe a bit overdone. Longer term, going back to this 10-year government bond yield chart, if this happens and this plays out and yields go back to 10%, this will basically put pressure on nearly all market sectors. And one thing that I would also like to show in the longer term picture, this is the CRB commodity index. It's very energy driven, of course, but it's still a good proxy to show what commodities in general are doing. And you can see that this strong rally here that started at the Corona crash in March 2020, so about 2 years ago, led to a rally of more than 200% in commodities. And I think they're overdone right now. You can see the monthly chart is strongly overbought. I would not be surprised to see a larger breather here. And that would also then mean that inflation is coming down. So I think the narrative that these high inflation numbers will continue to increase is a bit questionable right now. And I definitely would not rely on it. I think I'm much more towards risk off in general. There will be short-term trading opportunities. And since there is still a lot of liquidity in the market, you can always get these sharp and quick moves. So generally speaking, shorting these markets is also very tricky. But I'm right now rather defensive than aggressive.
Okay, so you're expecting some headwinds for gold and silver ahead?
Yes. So going back to my gold chart here for the next few weeks and months, maybe, I think gold is already in a correction that started with this top here in March. And we've seen now a lower high. And maybe we get this bounce over the next few weeks. It could already fail somewhere at the 1830, 1840-ish level. But I think gold is on the way back to its 200-day moving average, which actually is somewhere down here. So this would also mean a test of the breakout from end of January. You know, the gold went in this triangle, and then we got this sharp breakout move that took gold to 2070 within a few weeks. So I wouldn't be surprised if we get a pullback towards those levels. And I personally give my best to be patient and wait until early or midsummer, because that's usually a great spot to buy and add not only physical precious metals, but then also load up on mining stocks again.
The thing that's in my mind is, though, when I think of that cup and handle pattern and where we are in that handle, is it possible then, or have you ever seen a cup and handle where a handle consolidates for so long that it actually turns bearish?
I mean, the market can always do whatever he wants to do, right? This pattern could also fail. I mean, this is not written in stone. This is a technical pattern. The probability is there. But just if you zoom out a little bit, and maybe this cup and handle that I painted here is not the most beautiful one, but I think you get the picture. You can see that the handle is rather small. And I made this point already back in November, I think, at the Precious Summit conference. It's a very small handle. So for such a big cup, right? The cup has been in the making for nearly 10 years. So now the handle is about 2.5 years. Maybe it takes another year or something until gold is really ready to break out. In the long run, I have no doubt about precious metals. Okay, don't get me wrong here. I continue to buy and add on weakness, the physical stuff, because that's always the beauty of it. You can sit through all these crazy moves in the markets. You don't have to worry about it. It's in your hands. It's physically. There's no leverage, and you are out of the system. Whatever happens, so it's always the right move to do it. Just make sure not to overexpose yourself to precious metals, because some of the people are like 50 or 80% in bullion, which I think is too much. But having a decent, healthy position, something between 10 and 20% of your net worth, I think is absolutely a must in these times. And so I view it rather from, if we get this correction that I laid out towards the summer, it would be a great buying opportunity again. Gold had become a bit too expensive in March, and now we're correcting. By the way, we didn't talk about it yet, but the commitment of trades are terrible. I mean, they're not supportive of a bull run at all. And usually, and this is actually the last time that we had a really good setup in the commitment of trades is down here in August 2018. That's when the professionals, the hedgers, the bullion banks, they were net long the gold futures market. Since then, we haven't seen any real contrarian setup. They have been always keeping up a rather very high short position. And probably it will play out like always. They will somehow manage to get lower prices to cover those shorts. And once you see that they have reduced their massive short position to a very reasonable level, which usually is below 100,000 contracts accumulated on the short side, then you get a great entry signal again.
Silver is still range bound between 22 and 28. What is the sentiment for silver short term, and what kind of prices are you looking at as far as resistance and support?
Yeah, I don't have a chart for silver right now, but silver, I think, has been disappointing, obviously, over the last few months. I've been writing about that maybe we get this final spike in silver that would then also be a signal that this whole rally in the sector since December is coming to an end. But silver has been rather muted or not really performing, right? I mean, it would have been nice to see it rallying back to $30, but it didn't manage. And I think there is too much silver bulls out there that just rather hoping than accepting. Then silver's time will come, but it's really a long-term play. I don't trade it personally because it's, in my opinion, too much of a tricky market. And if you look at the longer term charts, silver is still trading sideways between $20 and $30. So as long as it doesn't break out of this range, it needs to break out above $30. Unless this happens, silver is trading sideways to lower. And this has always been the time that most of the time silver is lagging. Holding it physically, again, is a great way to position yourself for the end game in terms of very high inflation down the road. I mean, long term, this money printing will continue, of course. So maybe the markets are right now in a risk-off scenario. But once we get a serious recession, the Fed will have to come up and print again. So this whole scenario that played out between 2012 and 2018, where it took years and years until basically the Fed started hiking, and then they destroyed the markets, and then by Christmas 2008 they had to roll back and then basically lower interest rates again and pump the markets higher again. I think this is a similar setup that we are in right now, but it's going to happen much faster. So I don't think we have to wait another 5 or 6 years. I think it's going to play out within a few months or a year maybe. And once we are back at expanding the balance sheet, you will see that silver is also taking off. But until then, again, patience is king.
Yeah, we're all learning a lot about patience with silver. I still have my silver laser eyes avatar that I'm waiting to put up one day, but I guess I'm still gonna have to wait. Florian Grummes from Midas Touch Consulting, we appreciate your time and your short-term outlook, and we'll expect to plan for those headwinds ahead and enjoy the tailwinds to come. Thank you for coming on again.
Thanks for having me, Patrick. Always a pleasure. All the best for you and the viewers.
That was Florian Grummes from Midas Touch Consulting offering up his views. As always, please leave your thoughts in the comment section below and remember to keep it liquid, keep it real. And I'll see you on the next episode of Metal Money.